Hey all, this is Shubhankar here from Quantsapp. Welcome back to another episode. So, in the previous video of this episode, we had understood about what exactly options are. There are two types of options basically. It is a call option, then there is a put option. Both options involve buyer and seller both. Only then a contract will get created. So, talking about this video, specifically we are going to discuss more about what exactly is a call option. So I would recommend you watching the previous video as well, because that will give you a better understanding about what exactly options are. So taking straight to the definition of what exactly is a call option. So call option is a contract. So we all know that options are a contract, right? Which allows the buyer right. We have a right, but not an obligation to buy an underlying. Okay? We are having the right, but nobody can enforce us to exercise the contract. Options, they have a specific time frame, so they also have an expiry date, as we had understood it, that they have an expiry date in futures as well. The same way options also have an expiry date, even call options do have. Call option also have a predetermined or a specified price, which is known as strike price, which is also called as exercise price. Call option profits when underlying price increases. So whenever we buy a call option, our profit will only increase when the futures price or the underlying price, when it goes up. If it goes down, we are going to make a loss. Now let's directly take this particular definition straight into the practical implementation of it. So now, to make it simple, we have an option chain tool on our application. So you can open it, wherein once we open the option chain, you will directly get to see the details of each and every options out there, wherein first we need to select our desired instrument. So I'll go ahead with TCS right now, then expiry date. So this is the predetermined expiry date, wherein this contract won't be valid any day above this particular date. Okay, to make it simple, even if we enter any of the contract in this entire option chain, this contract will have no value as such one day above this date, which is 29th of July. Now who decides the expiration date? So expiration date is for stock options, it is every last Thursday of the month, and for index options they do have weekly options as well, wherein in weekly options the expiry date becomes every Thursday of the week. So if Thursday happens to be an holiday wherein the market isn't open, so Wednesday becomes our expiry date. So now coming to the second point, which was strike price. So what are strike prices? So I would say the figures which are mentioned in the middle of the option chain, those are our strike prices. So now let's take an example. The strike price of 3220, which is quoting at the premium of 61.7. Okay, so now what does call options tell us? So call option tell us that you will be receiving a right to buy TCS 300 shares at the level of 3220 rupees as on the expiry date. So first scenario is clear, that we are getting a right but not an obligation to do what? To buy TCS at a specified price, which is at 3220 rupees. And how much quantity can we go ahead and buy TCS's one share? No. We need to go ahead and at least buy 300 shares of TCS or multiple of it. You can't make an option contract or a future contract for your desired number. Ki you want, okay, only 150 shares of TCS I want to buy it. That won't be possible. Exchange decides the lot size and we need to adhere to it. Coming to the second example of what exactly strike prices are. Let's say if you buy the strike price of 3200, okay, you buy the call option of the strike price 3200, which the premium is right now 70.8 rupees. So you will be getting a right to buy TCS's 300 shares at the price of 3200. Similarly, if you buy the strike price of 3150, the premium is quoting at 101 rupees. You are getting a right to buy the TCS at 3150 rupees. So that is what a strike price is, basically at what price your contract will be exercised. So now let's try to understand how this premium is going to react in respect to the movement in the underlying. So I am in option chain what if analysis. It would be in the chain tool itself, wherein we can do some simulation and it would be crystal clear picture, I would say. Now let's say price right now of 3220 call option is 61.7. okay, so now in this scenario, what is our investment? Our investment is 61.7 into 300. So I would say roughly around 18,500 or 600 would be the investment to buy this particular option. Now why we are buying it? Because we want the right to buy TCS at 3220 rupees, and how much shares? 300. Now what will happen to this option if 5 days from here, okay, I'll just move the day slider to 5 days. In the next 5 days, if TCS's price goes up till 3260 rupees, okay, what is going to be the impact of change in the underlying price on the premium? So the premium which was quoting at the premium of 61 rupees, that has moved directly to 77 rupees. So this 15.68 rupees becomes our profit. Now why it has happened? Because eventually my future price has gone up, and that is the reason this premium has also gone up at the same time. Similarly, if you focus entire of the option chain on the call side, all of the option premiums have gone up. Similarly, let's try to understand the negative effect of it. Let's say if the prices of TCS go up till 3000, okay, and 5 days from here, what is going to be the impact of my premium? So the premium which was quoting at 61 rupees, that premium has gone down up till 2.67 rupees. So in this scenario, we are making a loss of 59 rupees out here on the strike price of 3220 rupees. As simple as that. So if the price goes down, call option price goes down. If the price goes up, the call option premiums also go up. So now let's try to understand the scenarios. So first scenario is the price of TCS goes up. It goes up till 3300. So now obviously we are going to honor the contract. Why is that so? Because we are going to get TCS's 300 shares a right to buy it at 3220 rupees minus the premium which we paid. So obviously that scenario is going to be in profit. So we can go ahead and buy it. The second scenario is, let's say for whatsoever reason TCS goes up till 2900, or let's say whatever price on the lower side, okay, lowest point possible you can imagine. If TCS goes anywhere, your maximum loss is going to be 61.7 rupees. That is the amount of premium which you paid. So TCS goes anywhere, it's your call. You can go ahead and simply leave the option premium which you paid. You don't need to exercise it. In the second scenario. Third scenario would be if TCS's price remains wherever it is, then again the right but not an obligation wala logics come into play, wherein if the situation is in our favor, we go ahead and buy that particular I would say underlying, or simply let go the premium which we paid. There is no hard and fast rule. And the last important thing which a lot of participants do, wherein you square off the contract in between. Let's say for what happens if, let's say if the price of TCS goes up till from 5 days from here, goes up till 3260, okay, so you simply sell the contract to someone else and you exit out your open position, and you are going to make a profit of 15.68 rupees. So as simple as that. That was the fourth scenario. Now to sum it up very quickly, what is call option? A contract allowing right, not an obligation, to buy the underlying at a specific time, which is the expiration date, at a specified price. We had the right to buy TCS at 3220 level, for which we paid a premium of 61 into the lot size. Profits when underlying price increases, and it will give us a loss when underlying price goes down. So I would say that was it from this video. In the next video, we are going to understand what exactly put options are. So stay tuned along with us. Do hit the bell icon, do hit the subscribe button. So whenever we post something, you will receive a notification. Thank you.